Good morning. Today we are starting our class on management accounting, and we are continuing with the final part of the ratio portion. Now we had continued with the inventory ratio, the basics of the inventory ratios, the debtors ratios, and all that. Now we are continuing with the debt to equity ratio. We are starting with that, and it calculates. However, we had short-term debts or long-term debts to the total equity. How much is the debt able to pay the equity shareholders? We have the total liabilities divided by the total shareholders equity. Now to this we have the interest coverage ratio. Now interest coverage ratio is actually shows how easily a company can pay its interest expenses. Now, debt to equity ratio has short term, long term, and total debt to equity ratio, as previously says. We also have interest coverage ratio. Means, say you have to pay your debtors or you have to pay your creditors, the person or say your debenture holders, your long term loans, or even the company deposits. You have to pay interest. So, how much interest is it are you able to pay? Now the ratio must always be greater than 1. If it is equal to 1, you could be in trouble, and if it is less than 1, you are in very big trouble. Now it is operating income. What is generally operating income is earning before interest and taxes, EBIT, by interest expenses. Now that is what is operating income. How much of that is available and how much is interest is be paid. Say your EBIT is 10 lakhs and your interest expenses is say 1 lakh. So 10 lakhs divided by 1 lakhs is 10. So that means you still have enough money after providing for the interest. This is very important because it speaks about the financial health of the company. Because no matter if we have a higher financial leverage, if we have more debt and if we derive more debt and more on debt and less on equity, but this interest coverage ratio should also be taken into account when covering or when carrying out all these tasks and all that. Mm, Now you have efficiency ratios. Now if you have efficiency ratios, which are also known as activity financial ratios, mm, now efficiency ratios, also known as activity financial ratios, are used to measure how well a company is utilizing the assets and resources. By utilizing, what do I mean? By utilizing, we mean that the asset turnover ratio to measures the company's ability to generate the sales from the asset. Net sales by total assets. Total assets means it includes fixed assets, it includes capital assets. How much total assets are does the company have, and it includes all even current assets and everything, assets and resources, whatever it has, and what is the sales in comparison to. The higher the ratio, the better. The efficiency ratio, it includes actually capacity utilization, it indicates capacity utilization, it indicates how much efficiently the company is financing, and it should be always equal to or greater than 1, because if we are greater than 1, then we are utilizing it better. If we are less than 1, means it is underutilizing of capacity. Now we also have inventory turnover issues. We did that. We did a part of that. We have cost of goods sold by average inventory. Now, when we have cost of goods sold by average inventory, what do we have here is the cost of the average inventory means the average of opening and closing stocks, and cost of goods sold is the total cost related to the production of the goods, and The accounts receivable turnover ratio measures how many times a company can turn receivables into cash. Receivables turnover ratio net credit sales by average accounts receivable. Average accounts receivable, it starts with say the debtors at the beginning of the period and debtors at the end of the period, and net credit sales during the period. The receivables turnover ratio means how much are you of the debt are you recovering, how much of the amount are you recovering from the debtors. Now what the positive point here is net credit sales, if the amount is more, if you are recovering more, then it will be greater than or equal to, it will be almost equal to 1, because if net equal to 1 or even greater, it will never, however, it can be greater than 1, but however, if it is less than 1, then you are in trouble, because you are then your credit sales are less and your debtors are outstanding more. So it should, if it is greater than 1, then that means your average accounts receivable is very low and your credit sales is good. That means you are getting your money back in more time. The days in inventory ratio measures the average number of days that the company holds on to its inventory before selling it to the customers. Now, days sales in inventory ratio is 365 days by inventory turnover ratio. Now, what does it implicate? It implicates the amount of days the inventory is held by the company. Now, the lower, the better, because the number of days the inventory is held in stock, the more the capital, the working capital of that particular company is held back. The more the working capital of that particular company is held back, the more that company needs to borrow and needs to uh, borrow to fund its operational expenses or its working capital expenses. So this is the very vulnerable and a very big point in operational expenses. And we also have this thing. So we have to keep this in mind. We also have profitability ratio. The profitability ratio, it measures the company's ability to generate the income related to revenue, balance sheets, operating costs, and it is generally divided into two parts: the gross margin ratio and the net margin ratio. Is how much of the gross and the net profit and thus is the company able to retain. It gives us an idea about the company's profit retention capability, or how much are the expenses eating up your sales revenue. So you have two. One we have is the gross profit margin ratio, and the other we have is the uh, operating margin ratio or operating income, or the earning of interest and taxes by net sales. So means how much of the profit are we able to retain, because the more we retain, the better. The return on the asset sales ratio measures how efficiently the company is using its assets to generate the profit. This is a return on sales ratio, gives us the net income by the total assets. Return on assets ratio, net income, return on the fixed assets ratio, you might have return on current assets, we might have return on equity ratio. It is the net income or earning before tax and taxes in general terms divided by the shareholders' equity. Now, what do we mean by shareholders' equity? It means only the equity shareholders, in the amount that is issued and subscribed by the equity shareholders. Now, in this return on equity shareholders, it is generally applicable only to the equity shareholders, and generally measured by from the equity shareholders aspect only, and not from any other aspect. And these ratios are few of the main ratios. There are multiple number of ratios, but these are the few main ratios that we need to cover and for our analysis of the balance sheet chapter. Now we also have the book value ratios, the earnings per share ratios, which we are going to discuss in our next class, and we are going to continue with this our market value ratios. I will start continue with that. Market value ratio gives us the book value per share ratio, which gives us the shareholders equity by the total shares outstanding. The total shareholders equity by the book value per share calculates the per share value of a company based on equity available to shareholders. Shareholders equity by the total share includes the equity and the preference. The dividend yield ratio, the per share value of the company based on the equity available to the shareholders. Now, dividend yield ratio that is total shares outstanding means total number of shares. The shareholders equity is the total number of share capital based on the book value. Book value is the total assets, that's the total liabilities. Now, that dividend yield ratio measures the amount of the dividends attributed to the shareholders to the market value per share. The dividend yield ratio gives us the dividend per share by the market price of the share. Now, what is the market price of the share is governed by the secondary market and not by the primary market. The earnings per share, the EPS, gives us the net earnings divided by the total number of shares outstanding. Or the EPS gives us the net earnings means EBIT by the total number of shares outstanding, and that is the total number of equity shares. The price earnings ratio is the share price divided by the earnings price, earnings per share. Now, this also compares the company share prices to earnings per share. Price earnings ratio is a pure term and gives us the absolute value, and is very easy to compare for intercompany measures. This is the end of the ratio analysis, and then in the next class we are going to start with the new problems.